Let's talk to Mark Oswald. He's a strategist at ADMISI. Very good morning to you, young Mark.
Good morning.
Right, as always, you've sent some thought-provoking slides. Without further ado, let's kick off with, I guess, the most important chart on the planet at the moment, the 10-year yield on the US.
Well, yes and no. I think really the alarming part of this chart, given that we've had all this melodrama about trade tariff tensions, about meltdowns in stock markets, about emerging market meltdowns, and what have we got in terms of a trading range for the US 10-year yield since the beginning of July? 21 basis points the whole time. So it's not exactly been volatile. To some extent, I suppose some people would argue, well, the Fed's still very clearly on a rate tightening trajectory, so we can't really charge too heavily in terms of flight to safety, flight to quality into the US 10-year. On the other hand, one would also have to say that the Friday move that we saw in reaction to the average wage numbers was very, very modest by any historical standards. And the concern has to be that if we are starting to see some traction on US wages, and the jury's out on that, that might have just been a one-off, but it is an 9-year high on that front. So it is a notable moment, and it's something the Fed will take notice of. If it gets into the 3 to 4% range that they would like to see, then they may actually have to think about upping the pace. But leaving that aside, this is really more about, are we in a real risk-off scenario or are we not? So let's go and have a look at one of the other problem children aside from emerging markets, and that's Italy. And I think really this is one of those charts which tells me a lot about where we are at the moment. Because one of the reasons the US dollar has done so well, and one of the reasons the US 10-year actually hasn't gone too far, is simply because as much as US yields have risen, 295, even now, we were 280 for most of the quarter, is not exactly a handsome return by any historical standards. Yep. So if you get into a situation, as we have with Italy, where there's been enormous amount of concern since the election, first the non-government, then the threats to basically have a big old punch-up with the EU about their budget, and suddenly the new government in Italy, above all Mr. Salvini, the leader of the Lega Nord, is talking much more conciliatory terms, and suddenly there's a big rush for Italian BTPs simply because the spread widening that we've seen offers an opportunity to add to returns, particularly in the euro area where bond yields have been ranging 0.3 to 0.5 for so long and really just offer no justification for holding them. And it's also the reason why, if we look at this next chart and we look at the 2-year yield, that's performed even better. The big spike was at the beginning of the year. Some of that big spike, I would have to say, immediately post-election is also a reminder of how poor liquidity is in financial markets, which is a thing to bear in mind, because when we still are in this environment where we're investing because we're financially repressed, because returns in bond markets are low, so we look at every opportunity of a rise in yields as potentially a buying opportunity rather than saying, well, what is the inherent risk with this? Is it going to crystallize or not? If it's not going to crystallize, then we better jump back in. And it really does remind me that people suddenly look at this and say, oh, well, it's not the problem that we thought it was. But if we've got that sort of illiquidity that we saw earlier in the year in financial markets, we do need to be wary that if we do get a more broader-based risk-off scenario, we are going to be in a somewhat problematic situation. So that brings me to the next chart on here, which is, are we actually seeing a very substantial rise in volatility? Well, actually, relative to the February so-called Volmageddon that we had, the rise in volatility, despite the 8 days of falls, and people are talking about this being the worst performance in equity markets since the beginning of 2016, and there's a lot of hand-wringing. We're not actually a million miles away from the highs, and volatility has certainly not spiked. And you'd need volatility to spike rather more substantially than we have seen for it to be a real signal. I'm not saying this can't develop further, but I would say Are investors panicking? Not on the basis of that evidence, either in the white line, which is the VIX volatility, i.e. on the S&P 500, or the V2X, which is the volatility on the Euro Stoxx 50. Neither nor. In fact, they're both trading in a much similar pattern. So that brings me to the final chart of the lot, which is going back to the whole emerging market thing. What is remarkable about this spread is actually when you look at the two spreads, the high yield bond in the US dollars average spread and the JP Morgan emerging market average spread on foreign currency debt, they have tended to trade pretty much in sync. We've not actually, yes, there are moments where one's outperformed the other, but in trend terms, it's been pretty similar. What we've seen in the last 3 to 6 months this year is emerging market bond spreads trending quite sharply wider,
yep.
While high yield bond spreads are basically almost at their lows. So clearly there's some evidence there of rotation into high yield bonds, but when you've got these things as tight as they are, and you're talking about the risk, say, perhaps of not so great set of corporate earnings as we go through the back end of the year, because we've done so well.
Right.
Not because they're actually poor corporate earnings, but how can you match the sort of earnings performances that we've seen in Q2 and Q1?
Yep.
And then you start to look at some of the high yield bond spreads, and you start to look at the risk that the Fed may actually have to up the pace, and you go, there's a lot of complacency built into that. And if you are sort of looking at it and saying, well, okay, emerging market bond spreads could be a lot worse, but at the moment, the real big risk lies in the high yield bond arena, simply because, yes, a lot of it may be energy, and we may love oil at the moment. It may be going quite well with Brent prices between 70 and 80. But in the long run, all of this stuff has to be refinanced, and gradually we're getting to the stage where it does have to be refinanced, and probably at not only higher rates, but potentially higher spreads. And that's where that complacency will probably be a chicken coming home to roost.
On that note, Mark, thank you very much indeed.